We believe that slowing growth, falling inflation, and reduced pressures on central banks to tighten policy further will create tailwinds for equity markets. It will be led by the US and Japan geographically and by more growth areas of the market from a sector perspective. This macroeconomic backdrop is likely to support an earnings rebound, with global earnings expected to grow around 10% in 2024. For the US, there are three main reasons for our overweight allocation. First, profit margins look resilient. Second, the technology sector is once again in the ascendancy, with the AI space increasingly in focus. And third, the US market is more highly exposed to sectors that are less susceptible to the economic slowdown. In Japan, we expect continued focus on increased corporate governance to drive increased share buybacks and dividend distributions to boost shareholder returns. This is supported by the very strong balance sheets in Japan, which is expected to encourage foreign as well as domestic investors to increase their allocation to Japanese stocks. Finally, when looking at sectors, we have a barbell strategy in developed markets. We're overweight on the more growth-resilient technology sector in the US and Europe, as well as the US communications services sector. On the more defensive side, we're also overweight the healthcare sector in the US and Europe. In China, we're more growth-focused, with overweights on the communications services, technology, and consumer discretionary sectors. Overall, we believe 2024 will start well for equity markets, but we'll keep a close eye on the economic data to see if the economy slows down more than expected later in the year. That's all for now. Don't forget to follow Standard Chartered Wealth Insights, LinkedIn and Facebook, or subscribe to our YouTube channel for more insights.